Welcome to Crypto 101, a first principles jargon-free course on blockchain and its impact on financial services. So far in this course, we have been learning about cryptocurrencies. In this lesson, we will expand our understanding to the 4 types of crypto tokens. We will then deepen our understanding of asset-backed tokens with the example of stablecoins. In the first lesson, we defined crypto assets as a digital token that resides in a blockchain network. We also defined a token as a physical or digital symbol that is ascribed economic value by those acquiring them. We can group crypto tokens into 4 broad categories: cryptocurrencies, asset-backed tokens, ownership tokens, and utility tokens. Next, we will define each one of them. We have extensively covered cryptocurrencies in this course. Cryptocurrencies are tokens on the blockchain that are designed to mimic the properties of fiat currency. Asset-backed tokens are crypto tokens that are designed to represent a claim on the economic value of a tangible or intangible asset. Ownership tokens are designed to represent an ownership claim on an intangible or tangible asset. They are similar to asset-backed tokens in that their economic value is derived from the value of the underlying asset. However, the token holder, in this case, has an ownership interest in the asset. For instance, a token that entitles the holder of the token to rent earned on a real estate property is an asset-backed token. But the token holder does not actually own the real estate property. An ownership token would mean that the token holder actually owns title to property. Utility tokens are crypto tokens that are designed to allow users to obtain an entitlement that is only available to the token holder. This entitlement could include the right to access a product or a service. For instance, a holder of a crypto token may have the right to watch movies of a studio pre-release. In this lesson, we will learn about asset-backed tokens. Asset-backed tokens can be of many types. Since this is an introductory lesson, we will focus on a popular illustrative example, namely stablecoins. A stablecoin is an asset-backed crypto token that is structured in such a way that each token maintains a set value in fiat currency. For instance, one could create a stablecoin that will always have a value of $1. Next, we will learn how this is achieved. Consider Alice, who buys a stablecoin from Bob, who is an issuer of stablecoin. Bob invests the $1 in a highly secure financial instrument, for example a term deposit in a bank. This ensures that the value of the one token will always be at least $1 in nominal terms. If Alice wants to sell the stablecoin back to Bob, Bob will simply withdraw $1 from the bank and give it to Alice. Token is matched 1-for-1 with fiat currency. What is the benefit of stablecoins? We can look at this from the perspective of the holder and the issuer. The holder of the stablecoin can make payments faster, cheaper, or both. For instance, the stablecoin holder may make a cross-border payment. Since the stablecoin value always remains $1 and does not fluctuate wildly like Bitcoin, merchants are more willing to accept it. The benefit to the issuer is return earned on investments made with the proceeds of the sale of the stablecoin. The issuer, in our example, earns interest income on the term deposit. Next, we will show how stablecoins can be used with an illustrative scenario. Alice is a retail trader who makes money by buying and selling Bitcoin on various cryptocurrency exchanges. Assume that she holds her coins in a custodial wallet operated by a crypto exchange called BitExchange. At 10 a.m. in the morning, the price of Bitcoin is $15,000. Alice initiates an order for 1 Bitcoin at that price. BitExchange matches Alice with a seller, Bob. Since both Bob and Alice maintain their coins with the custodial wallet offered by the exchange does a book entry. Bitcoin does not move between addresses on the blockchain. Next, we will look at the bank side. Alice's bank account is linked to the app of the exchange. When she initiates a purchase, the exchange debits her bank account for $15,000. The exchange needs the following to occur. Money must flow from Alice's bank account to a bank account owned by the exchange. From this account, the exchange transfers the money to Bob's checking account. In this example, we are assuming that Bob does not want to park his money at the exchange as he wishes to pay for some home renovations. Since these Alice, Bob and the exchange maintain accounts at different banks, the money transfer must occur via the banking system. Now we can bring the two sides together. On the crypto side, Bitcoin ownership needs to be transferred from Bob to Alice, on the books of the exchange. On the fiat money side, money needs to move from Alice to Bob. The bank account owned by the exchange acts as an intermediate account. However, the movement on the fiat money side can take 2 to 3 business days within the banking system. Let us go back to our trader, Alice. At 10 a.m. Monday, Alice bought 1 Bitcoin at $15,000 on BitExchange. At noon, she discovers that she can get a slightly higher price for her Bitcoin at another exchange called ByteExchange. Hence, she wants to transfer the Bitcoin from the wallet of BitExchange to the wallet of ByteExchange. But BitExchange stops her from doing so. BitExchange runs the risk that Alice does not have sufficient money in her bank account. If BitExchange allows her to transfer the bitcoins to another wallet, it may not receive the money and have to pay Bob from its own account. Alice has to wait for 1 or 2 business days till the money is received by the exchange. Now, we can see this from the perspective of Bob. Bob is anxious to get his fiat money because he is planning to buy a car that day. But the exchange does not allow him to transfer cash to his checking account till cash is received from Alice. Now consider what happens when, instead of fiat money, the purchase of Bitcoin is settled via a stablecoin that is managed on another blockchain. Let us call this the altcoin blockchain. The exchange is maintaining custodial wallets on both blockchains. It transfers Bitcoin ownership record from Bob to Alice on the Bitcoin wallet. It transfers altcoin ownership record from Bob to Alice on the altcoin wallet. The two occur simultaneously. Note that the price of Bitcoin in this example was $15,000 and one stablecoin represents $1. We can now generalize the utility of stablecoins beyond the scenario that we just reviewed. On the left, we are buying goods, services, traditional financial assets or crypto assets. On the right, we are paying for them. We will call the left side the delivery side because a tangible or intangible product is being delivered to the buyer. We will call the right side the payment side. By replacing fiat money on the right with stable coins, 2 outcomes can be achieved. First, reduce the operational friction and costs involved in moving money between bank accounts. Second, reduce risks that arise when the delivery leg and the payment leg is not near simultaneous. If we now take a step further, we can reduce the left and the right side to 2 categories, crypto tokens and everything else. The greatest benefit of stablecoins arise when the delivery leg also consists of crypto assets. In such scenarios, the transaction can be settled on the blockchain. Buying Bitcoin with stablecoin is an example of this scenario. However, the benefit reduces if the delivery is off-chain. For instance, if you were buying a house, the legal title is typically recorded in an off-chain government database. Paying with stablecoin instead of fiat money will not yield much incremental benefit. Of course, one day, the state itself may record legal title on the blockchain. Stablecoins are used to make payments. But they are different from cryptocurrencies. A cryptocurrency is genuinely a new form of money. A stablecoin, on the other hand, are crypto equivalents of traveler's checks. They facilitate commerce on the blockchain, just as traveler's checks enabled commerce in foreign lands. A cryptocurrency's value is derived, at least in theory, from its intrinsic properties. Stablecoins derive their value from the value of the underlying financial assets that back it. Historically, money is a store of value. It is also a medium of exchange, whereby people use it to pay for goods and services. Cryptocurrencies, like traditional money, act as a store of value. However, their value has historically been very volatile. As a result, it is risky to use them to make or receive payments. Stablecoins solve this problem by stabilizing the value. In this lesson, we have covered stablecoins as an example of an asset-backed token. But in theory, asset-backed tokens can represent anything. For example, the token issuer could be a landlord who can receive rent from multiple properties. The rent then accrues to token holders who have purchased tokens from the landlord. Alternatively, the token issuer could be a bank which receives cash flows from car loans, which then accrue to token holders. This brings to the end of this lesson. In this lesson, we developed an understanding of asset-backed tokens and did a deep dive into stablecoins as an illustrative example of such a token. However, the discussion in this lesson has been theoretical. In the next lesson, we will learn about a real-life example of a stablecoin, called Tether. But before we proceed to the next lesson, review the summary of this lesson.